I'm very pleased to bring on the CIO from Verano, Aaron Miles. Aaron, come on back. Everyone give it up for Aaron Miles, please. I think someone stole your clicker. Let me get that for you, Aaron.
All right.
Do you have the PowerPoint?
It's my first in person in about 3 years. I was joking that I need cutouts of computer screens in front of everyone's faces here for Zoom.
I knew someone was going to do it. There you go.
All right. Well, thank you for having me today. I'm actually really excited to be here. As you mentioned, my name is Aaron Miles. I'm the Chief Investment Officer with Verano. I've been here for about a year, helped take the company public, which has been a whirlwind, especially from a virtual perspective. But really excited to talk about our story today and kind of give you the overview of where we're at. So for those of you that don't know, Verano was established in 2014. We were established with an operational mindset. Our founder and CEO, George Arcos, has a hospitality background, a logistics background, operational background. And when he saw the opportunity present itself in 2014 in the state of Illinois to acquire one of the cultivation licenses, he applied and won and immediately went to work, realizing that this is definitely a profitable industry to be in. A little bit different in 2014 compared to where we're at now. But he went to work, went out to Colorado, learned how to grow, went out to California, learned how to extract, and came back to Illinois and realized that he could make a lot of money in the cannabis space. And one of the things that sets us apart as a business is that George had a blueprint from day one. Given that operational background, that hospitality background, he was able to layer that on top of this opportunity and really build the business to where we're at today, which is 86 active dispensaries across a 14-state footprint with active operations in 11. We have vertical integration in 9 of those 11 states, 11 cultivation facilities, and we're continuing to expand from there. And when I talk about being profitable, one of the biggest challenges in this space is producing cash. And, again, given George's background in the operational expertise that he had, we've been profitable since inception. So having the luxury of being able to invest cash flow back into the business to get us to the point that we're at now has established the footprint that we have. So really excited about what we've done, what we're doing, and kind of where our focus is at. So this slide right here just kind of gives you a quick snapshot of really where our active operations are at. And this has evolved rapidly since we've gone public. For those that you don't know, we went public in February. And have rapidly expanded from both an organic and an inorganic perspective. And one of the biggest things that we've been able to accomplish in this space is investing ahead of market growth. If you look at this slide right here, this is the core markets that we have. So when I talk about investing ahead of market growth, if you look at what we've done in Illinois, we've maximized our footprint. You're allowed 10 dispensaries, and we have that. We have a massive facility down in Albion. And, again, leveraging that cash flow to build the business, to have cultivational capacity, along with the max footprint in the dispensary arena, help position us well ahead of a market that transitioned over to adult use. So we're taking that mindset and we're applying that to every other state that we operate in. So Florida is very similar. It's a medical-only market right now. We have 38 dispensaries, a massive facility in Apollo Beach, which is right by Tampa. And we're building a second location, which I'll get, kind of get more into the cultivation here in a few minutes, but a second location in Palatka, which is going to help kind of continue that expansion into Florida. And this is definitely a market that's primed to go adult use at some point. So we're positioning ourselves well there. Arizona, and I should mention too, Florida and Arizona were both assets that we acquired through the AltMed transaction, which gave us an accelerated footprint in Florida and entrance into Arizona. So Arizona, we've expanded to 6 operating dispensaries through 3 strategic M&A transactions that we've done. And we have about 110,000 square feet of cultivation capacity coming online very shortly. Part of that's already online, and we're also going through an expansion. But Arizona, we have a top 3 market position from a retail perspective and a very large capacity from a cultivation perspective as well. New Jersey, we've all heard about New Jersey. It's a market, again, that we positioned ourselves in with 120,000 square foot cultivation facility and the maximum allowed 3 dispensaries. And I can tell you the interior, it's kind of our show pony. Everything we've learned across our other states, we've implemented into our New Jersey facility. And that really helped position us well ahead of a market that is transitioning over to adult use. When that happens, right now it's mandatory by February 22nd of next year. We'll see if that actually happens, and hopefully it pulls forward a little bit more. But we are positioned in that market ahead of that happening. Pennsylvania is another market that's primed to go, transition over to adult use. And, we had a very small footprint in PA. We only had 3 dispensaries active, before really going on a very strong strategic and deliberate M&A transaction route in PA, where we closed on 5 transactions. And it gave us the ability to have 18 dispensaries along with 2 cultivation facilities. So again, kind of using that mindset of investing ahead of market growth has positioned us well in that state. And I'll kind of go through these next ones quickly because I know we have some limited time here. But Ohio, max, 5 dispensaries allowable. Cultivation facility that is, allowing us to wholesale in that market and obviously put supply into our dispensaries as well. Nevada is another market that we haven't been shy about. We, have gone deep in Nevada and want to continue to go deeper in Nevada. We announced the Sierra Well transaction, which is pending. So pending the close of that, we'll have 5 dispensaries along with 2 cultivation facilities. And then Maryland has been a legacy state for us, 4 operational dispensaries along with a cultivation facility that, that's under current expansion from a canopy perspective. Some of our other markets, Massachusetts, 2 dispensaries, again, haven't been shy about wanting to maximize our footprint from a dispensary perspective on that front. And, 26,000 square foot cultivation facility that is ready to go. We just want to, waiting for regulatory approval to put plants in the ground, and then we'll be vertically integrated in that market as well. And then Michigan and Arkansas are 2 states that we have a dispensary in. And then I should mention on here as well, West Virginia, we won the ability to open up 7 dispensaries along with a cultivation and processing facility. And we're in the process of building that out. So what is, when we talk about vertical integration, one of the signatures for Verano is our margin profile. And we've throughout the history of the company, as I talk about being profitable and really achieving, strong results in the bottom line has been a signature of the company. And that's achieved through vertical integration. And so as we scale and as we continue to take that positive cash flow and invest it back into the business, we're going to continue to put more capacity into the market, which, in turn is going to come back on the margin front. At least that's the plan. And, kind of help continue to, maintain, that strong margin profile that we have. So M&A, as I mentioned, we have been very, very aggressive since we've gone public. So not including the AltMed transaction, we've closed on 10 acquisitions over the last 8 months now, and then we have 1 pending in Nevada, as I mentioned, with Sierra Well. So AltMed, as I mentioned, gave us an accelerated footprint in Florida, entrance into Arizona, and we've obviously been able to leverage both of those assets. PA, as I mentioned, we had gone very deep. We acquired 5 companies in PA. Terra Vita gave us the 3 top performing stores in the Philadelphia market. The Healing Center gave us 3 of the top performing stores in Pittsburgh. We have ability to open up 3 more in Philadelphia. We acquired Agrikind, which we closed at the beginning of July, which unlocked vertical integration in Pennsylvania. And then we acquired a clinical registrant license, which gives us the ability to open up 6 additional dispensaries along with a cultivation facility where square footage is TBD. So, right now we have currently 7 expansion projects underway. From a canopy perspective, we're building out that, that facility in Massachusetts that I mentioned. And then the next phase is going to be build outs in PA for a second facility and then the Florida facility that I had mentioned. So yeah, in Arizona, we did 3 transactions. I mentioned that as well. That gives us 6 dispensaries as well in there and a few other cultivation facilities. So our brands, I think this is a hot topic for the industry. And, one thing that we do is we don't try to jump the gun and get too far ahead. And, again, we invest appropriately, in headcount and opportunities, and we really try to stay ahead of market growth and reasonably grow the business and not get caught flat-footed. And I think brands are an area that kind of fit into that MO. The industry itself, the brands are really in the infancy stages. It takes a long time to build a household brand. And what we're doing, given the state-by-state nature of our business, it presents a lot of challenges when you're trying to create a cohesive brand across your portfolio. But what it also does is it gives you the opportunity to really leverage your consumer base to learn, state by state, different demographics across your consumer base and the different, geographic areas that you operate in to solicit feedback and then implement that back into your brand strategy. So we have been, and we are currently doing that, where we're going to enhance our brand portfolio and continue to listen to the market and try to create a cohesive product across our brands. And the idea behind this, and if you go back to George's background in hospitality, we operate under the mindset that the last time that you consume one of our products, that's what you're going to judge us on. And when we get to the retail section, it's the same thing. The last time you go into one of our stores, if the music levels aren't correct, if you aren't greeted, if it's not clean, if the product supply is not there, that's what you're going to judge us on. And we want to make sure that, from a branding perspective, that we create a very consistent, high quality brand, which we have, from day one. And make sure that the customer experience continues to be in line with what our expectations would be from a company. So Verano is our flagship. We've always operated at the top tier premium price point. We've been able to grow very large scale, high quality product into the market. So it's our flagship brand. Really the flower, the vapes, the concentrates would run through the Verano brand. Encore is our edible line. Obviously, there's a lot that we can do within the edible front, looking at different form factors, have it be beverages or, different types of edibles that would roll out through that. But again, that kind of goes back into that soliciting the feedback from your markets that you operate in to make sure that you're putting the appropriate products out and making sure that, in each area that you are rolling out products, it's not a one size fits all. We might have to tailor it to some of the different states that we operate in. Avexia, this is obviously a very, very focused medical product as well. And kind of Move, which we acquired through the AltMed transaction, would fit very much in that medicinal look and feel product as well. So definitely investing in our brands, and we'll continue to do so. But I mean, if you look at some of the global household brands that are out there today, it didn't develop overnight, and we're not naive to the fact that it's going to take time. But again, continue to invest money and continue to invest the right resources. We feel that we'll definitely be able to create a brand that is leveraged across our footprint consistently. So retail, as I said, we have 86 dispensaries right now. The bulk majority of those operate under our ZenLeaf platform. And this is, as you can imagine, this is George's baby right here. I mean, you go into one of his restaurants, and again, the quality of the product, the cleanliness of the table, restaurants, everything across those boards, that mindset it has been implemented into this retail basically focus that we have here. So ZenLeaf is our house brand. This is really where, we want to create that consistent feel. And this goes back to the products as well, as if you're in Maryland and you consume flower in Maryland, we want it to be, very similar product quality as if you were in Illinois. And the same thing with ZenLeaf. We want it to look and feel the same across the board, because, once things do open and we can create a true national brand, that's what we're doing. We just have to do it on a state-by-state basis right now. In Florida, it's where the Move dispensaries are, and obviously perform extremely well down in that state. Move in Florida in general, the one thing to point out, our Apollo Beach cultivation facility is all indoor. And, when we talk about that, top tier price point and that premium flower, that's where our focus has always been, is high quality product. And we've carried that down into Florida with, through the AltMed transaction as well, which, they were already creating, very, very high quality products. And we've kind of implemented best practices across both junctures here to continue to kind of enhance the product portfolio down there. But Move is the legacy brand in Florida. And, we'll continue to nurture that and expand our reach down in Florida as we have more capacity to come online. So now what everybody is always focused on is the financials. As I said, this is where our signature is being a profitable business. And on a top line perspective, we nearly hit 200 million in Q2, which was 164% growth year over year and 39% quarter over quarter. Really driven again by, organic investments, inorganic investments, and really just that operational mindset that we have to continue to push the envelope. And what that did is that produced 100 million in gross profit, which, 50% is good. We had some accounting noise, and I won't bore you with the details, but it impacted our gross profit margins by about 8% in the quarter. So as you shift away from some of the accounting noise we had in Q2, we definitely feel that we'll get back, closer to our legacy of around 60%. And then adjusted EBITDA, 81 million, that was 41%. Again, impacted as well under IFRS, biological asset adjustments. I mean, there were some impacts to this figure as well, but, still very strong numbers in the quarter. And, we'll continue to push towards, the bottom line. Because at the end of the day, you produce cash, you can invest that back in your business. It's definitely a luxury to have to self-fund CapEx. Financial health, this has always been another signature of the company here. We've been good stewards of capital. We've been very minimal on the equity raises. We did one equity raise before the go public round of $100 million in February of this year, and then we did a bought deal right after we went public. So 3 equity rounds to the point that we've been at now, and $130 million of debt, which came in 2 tranches of $30 million and $100 million. And, I think one of the things that I've gotten pushback on in the market has been, well, do you need to take more cash? And the one thing that we like to point out as a company is, again, if you think about how we invest ahead of market growth, we look at cash needs and we look at the way that we're going to leverage and access the debt markets. And so what we do is we take what we need and then we look to what we need in the future and try to improve upon those terms. We could rip $300-400 million right now in sale leasebacks. We don't have any, but that's just something that we have in our arsenal if we ever need it. And so we have a lot of levers that we can pull, but we maintain very, very good stewards of capital going forward, and we'll continue to do so, from an under-levered perspective. And as I mentioned too, so free cash flow. So investing this back into the business is definitely a strength of the company. And what we want to do here is we want to run free cash flow as close to zero as we can get it, because that means we're investing all of those dollars back into the business. So 7 cultivation expansions, the Massachusetts facility, the 2 additional facilities, that's all going to come out of here. So to date, we've invested around $60 million in CapEx, project out about $100 million, maybe a little bit north of that for the remainder of the year, and very similar next year as we have different projects coming online. And so, as I said, capital strategy, I'll kind of move through these quickly and open it up for Q&A here, but it's, investing in headcount. Our SG&A consistently runs between 20 and 25%, and that's by design. And it's looking at the needs of the market growth. It's looking at, where we need to invest, and it's not overgrowing the business to the detriment of your margins or your SG&A profile. So we definitely invest in the right areas at the right time. We'll continue to do so and be very focused, again, on that bottom line. So the outlook, legislative outlook. I mean, again, we could talk about this for hours, but we're staying very closely connected to a lot of players in this space. We want a seat at the table. We want to make sure that we do have a voice in really trying to help shape how any potential program could roll out. So we're continuing to leverage our contacts, both from a regulatory perspective to capital markets. What we're doing is we're making sure that we're ready, if and when the floodgates open. And that's converting from IFRS over to GAAP. It's, filing our 20F, making sure that we're ready from, a registration perspective. And then just from a legislative perspective, it's working, on social equity reform. It's working with regulators to make sure that there's not just some blanket program that gets put out there, but something that actually is going to be beneficial for the industry itself. Operational outlook, as I said, obviously very focused on the cultivation expansion. Retail, we're going to continue to push the envelope there, get as many dispensaries open as we can. We anticipate 90 plus total dispensaries open by year end. And then additional, kind of drivers for the business, New Jersey rec turning over. And then obviously we're positioned well, as I mentioned, in other markets that are going to prime us as those transition over to adult use. So it's about as quick as I can go through that. I had 15 minutes, but I think I got through in about 18, but, open it up for Q&A.
Questions? Do you mind using that microphone right there in the middle? It's so lonely. Anyone else that has a question, please line up at the microphone.
My question is Verano looking to head into the New York market, either in retail or in cultivation or in both together?
Yeah, it's a question we get all the time. New York is a market we have been focused on at the same time everybody else was. We had opportunities to enter that market, and one thing that we've been very vocal on is the way that market has rolled out and the delays in the market. It's given us opportunities to invest in other states that have given us more near-term return on capital. But I can tell you that New York is a focus of ours, and what way we enter that market is yet to be determined, but we'll continue to evaluate those opportunities.
Thank you.
Go for it.
Hey, Aaron, thanks for the time. This is Harrison Vivas from Cowen. Can you just update us on retail pricing trends that you're seeing in Florida and Pennsylvania, and how you manage price gaps to the extent that you're seeing deflation there?
Great. Yeah, pricing has been a hot topic lately in the industry. And PA, Florida are two markets that we operate in that have definitely made some headlines from a pricing perspective. I think the one thing that helps us from a pricing perspective is operating at the tiers and the price points that we do. I mean, we discount, everybody discounts, but to certain levels of other operators, we're not in a race to the bottom, and we want to make sure that we maintain that premium price point. So we have seen a little bit of impact on pricing, but for us, even candidly, running some discounts, has helped the business. But in reality, quality of product a lot of times will trump a lot of the pricing impact or pricing mechanisms that we would need to leverage. So yeah, pricing is definitely something that we're focused in on, and there's definitely been some pressure in the industry. But again, operating at that premium tier has helped kind of weather the storm there.
Aaron Miles, Verano Holdings, everyone, give it up.
All right.
Thank you, Aaron.
Thank you.
Thank you very much.